Hello and welcome to Econoday Unplugged on Wednesday, the 8th of April 2020. Mark Pender is on US East Coast, Brian Jackson's in Sydney, and I'm Jeremy Hawkins here in London. Sadly, the coronavirus death toll continues to mount, but financial markets are clearly looking for light at the end of a tunnel. From its low point on March the 23rd, the MSCI World Index has risen around 19%. Its emerging markets counterpart is up 16%. In the US, the S&P 500 is up round about 25%. Whatever happened to the bear market? So the question becomes, can investors continue to look through what will be a possibly protracted period of very, very weak economic data? Will the weight of the impending global recession prove too much to handle? Anyway, let's see where we stand now. Bron, it's been a few weeks since we had you on the podcast, so perhaps you can kick things off with an update of the Southern Hemisphere, particularly China, where on paper at least, I guess, things do seem to be looking a little bit better.
Yeah, I guess the PMI surveys are the best summary numbers to look at what's going on. And they are sort of following the pattern that you probably would expect from just reading the news and sort of hearing about all the anecdotal evidence of what's happening in these countries, particularly China. So with China, we had obviously the very large drop in those PMI headline indices for February. That was to be expected. And then what we've seen with the March PMIs, which came out, sort of at the start of this month, is that, the headline indices have picked up a bit. That's not to say that, the economy has bounced back, but it's just sort of stabilising or close to stabilising around the low levels that we saw in February. So, not really indicating that we're sort of getting a recovery yet, but at least that the damage has been sort of contained and hopefully stabilised, and we can sort of see some improvement going forward. It is good to see that the official PMI numbers that Chinese authorities put out have been generally coinciding with the private sector PMI survey. So we can have some sort of confidence in that they're basically saying the same thing, that there has been that stabilisation, and that will also hopefully be reflected in the key activity numbers that we're going to be seeing for March in the next couple of weeks coming out of China, and also the GDP number.
Okay, but can I ask you about this, the state of the coronavirus out there? It seems that there's this sort of gradual easing of some of the lockdown measures and so forth. Is there any kind of concern that perhaps this is too early and the lockdown should continue for longer just to make sure that everything has been sorted out? Or is there a general sense that, okay, it's been handled and we're over that now, and now we're starting to look towards some kind of recovery?
Of course, it varies from country to country. Even this week, we've seen, Japan declare a state of emergency in some of the big cities there, and so that's ramping up some of the restrictions. Similarly, in Singapore and Hong Kong, they've tightened a few of the restrictions, but in China, they've removed the lockdown on Wuhan. So, across the region, people are seeing different numbers coming through in terms of cases and reacting differently. So it's hard to sort of generalize about what the response has been, but we are definitely seeing the center of the epidemic has moved from Asia then to Europe and now to North America. But there is definitely concerns that that there will be a sort of second wave going through this region. Mm-hmm. Of course, here in Australia, we've had some success, I think, in containing the spread, but of course we're coming up to our winter in the next few months as well, and so there's some uncertainty about how that's going to play out once we move into that season. So there's just been a range of responses and a range of reactions across the region.
I guess the other big question at the moment is Japan. I mean, as you mentioned, they've announced this state of emergency now, and I think they've also come out with this big fiscal reflation package. Yeah. Why do you think it's been, compared to the rest of sort of the industrialized world, Japan seems to be quite a long way behind in terms of the curve in the reaction process? Why do you think that's been the case? And indeed, is the danger that they've left it too late and any kind of downturn in Japan might be that much deeper as a result of that?
Oh, I think there's been waves of responses from authorities. They did act pretty quickly in some respects to I remember they shut down the schools and they put other restrictions in place pretty quickly. The Bank of Japan has moved to improve liquidity and to really try and make sure that monetary policy is doing all it can to support the economy. But definitely we've had now the fiscal package really amp up. They've had a few responses before that, but it's picked up definitely now. The thing about Japan also is that their manufacturing sector, even going into this crisis, was already pretty weak, and so this has just sort of compounded that problem. But they've definitely put in a pretty strong reaction now. Their fiscal package is worth close to 20% of GDP. So they're trying to do the bit, but there was definitely some issues in I think responding to acknowledging just the size of the problem early on.
Brian, this is Mark. Speaking of GDP, Chinese GDP for the first quarter is coming out next week.
Yes.
And I'm just looking at a large contraction, year-on-year contraction in the low double digits. And I guess that's going to be one of the very first views that we're going to get on the GDP impact, because China, it started earlier in January and February. If we, along with GDP in the coming week, we're also going to get industrial production and retail sales out of China. And those will be for March. And perhaps if we see improvement in March relative to January and February, I wonder what that would do to our own outlook for the global GDP if we're already in the worst of it now and it's going to get better. Is that a possibility that we'll be seeing next week with the Chinese GDP, or with the GDP numbers?
Yeah, well, I mean, if the PMI numbers are an indication, hopefully they'll at least show some stabilization from, the real hit that we took in February. So, we will be looking for those March numbers to sort of show some improvement. That said, the scale of the hit that we took in January and February suggests that, you will get a pretty weak number for the quarter as a whole. But, if we're looking on a month-to-month basis, it could be a story of some stabilization in March, and then looking forward, perhaps some sort of recovery starting to take place in April. And that's, I think, suggesting that probably the impact in China is perhaps 1 month ahead of where it is elsewhere. You've definitely seen that in the PMI numbers. Elsewhere in the regions, Singapore, Hong Kong, Japan. You saw a bigger hit to the PMI numbers in March, whereas in China it was February. And so, you're still definitely going to see, once the GDP numbers come out for the rest of the region, a big move, but sort of concentrated later in the quarter.
Oh, real quickly, now we have those Days calendar. We have those on Friday, April 17th.
Yeah.
Is that a fixed date? Have the Chinese actually fixed those dates, or are those estimates, or for the GDP and industrial production and retail sales?
Well, we're pretty confident that that's when those numbers will come out, but they haven't really nailed down their data schedule for the whole year like they normally do. So there is a little bit of leeway around that, but we're pretty sure that that's when they're going to come out. Normally around that time of the month, and so we'll see.
Okay, thanks, Brian. But before we let you go, since we last spoke to you, we've had both the reserve banks of Aussie and Kiwi introducing quantitative easing due to the impact of the coronavirus, et cetera. Do you think this, once we get through all this process, this is going to lead to some kind of sort of fundamental review of monetary policy in your part of the world, in the same sort of way as the ECB at the moment in my part of the world, in continental Europe, are they reviewing their overall monetary strategy? The fact that they're being prepared to go out and introduce quantitative easing, is this a fundamental shift or just a one-off emergency action and something they won't contemplate using in the future?
I think they would prefer it to be just an emergency measure, and they'd like to return to the business as usual once we get through this. But of course, the risk is that it's more protracted than they're thinking at the moment, and that they will have to keep on doing this for quite some time. And the problem is, of course, is that going into the crisis, policy rates were already pretty low, historically low, and they just never had that opportunity to get them back up to more normal levels that would then allow you to adjust policy rates, due to the normal cyclical factors that come along. So there is a risk that they'll sort of be in place for longer than they want to, but I think they would prefer to get back to the way they used to do things.
Okay, fair enough. Okay then, Mr. Pender, what is going on your side these days?
Initial jobless claims. They doubled in the prior 2 weeks from 3.3 million to 6.6 million. But much like the infection rate, we look at a slower rate of build here, at least for the coming week, where the kind of day consensus is 5 million. Now the consensus has been all over the place, and it's really anyone's guess. But right now, it's we're revealing week by week just how badly damaged the U.S. labor market is. Now let me ask you guys. I mean, do you see any labor markets as badly hit as the U.S.?
Well, so I think in terms of Europe, I can say so far no, although we are starting to see some early indications, because typically in Europe the figures come out rather behind your side of the pond, but there are some early indications that we will begin to see some fairly large increases in unemployment across all of Europe, and including the UK. But it's kind of more survey based at the moment rather than being in the hard data.
Yeah, I mean here in Australia, I definitely expect to see a pretty sharp jump up in unemployment. The government has put in some policies trying to really do all it can to keep people in their jobs. There's been wage subsidies basically to try and encourage businesses to hold on to those workers at least for the next few months. So hopefully that will put a dent in it. But there's inevitably going to be some reaction. In Japan, we also saw in the latest labour market numbers a tick up in unemployment and slower employment growth. But again, there might be a more willingness amongst Japanese firms to hold on to workers for a bit longer if they can as well.
I might mention just in terms of, looking at Ireland, as I think people accept trying to forecast these things these days is kind of anyone's guess. But the Irish Central Bank came out earlier on this week and they were basically saying that just assuming a sort of a kind of a normal distribution as far as the coronavirus is concerned, they'd expect to see local unemployment hit 25% during the course of this year. So that's a significant shakeout, and indeed they're talking about GDP for Ireland as a country contracting by 8.3% in 2020. So there are some big numbers coming out.
Well, you asked the question at the beginning, Jeremy. Will the markets look past this awful data that's going to be coming out?
Yeah, I really do wonder that. It does seem, I think, in previous sort of podcasts we talked about, the numbers, to concentrate on for investors who are looking, how are these markets going to go? We know that as far as equity is concerned, they tend to be very, very forward looking. So fair enough, when you take something like a PMI, yes, you got the headline index, but within the breakdown, we always, tend to pick out things like the orders sub-index as a kind of a guide to what the sort of pipeline demand is with a view to judging future activity. But now it seems, at least, well, for the moment anyway, investors are going sort of the next step and just simply taking the view that, right, we'll look at what's happening to the coronavirus figures, and once we start to see any kind of a hint of a peaking in those, and we touch wood, we've got bits of that coming through in the likes of Italy and Spain now, then they seem to be taking, well, that's it, it's all over now. And by the way, we got this massive global fiscal and monetary expansion, and that's all we need. But you do wonder that, there's going to be some pretty awful numbers coming up. And I should mention in terms of this, there's very few hard numbers coming out of Europe yet, but somewhat unexpectedly, we did have some figures out of the National Bank of France this morning. Now, these aren't the official GDP numbers because it's ANSI, the stats guys who put those together. But the Bank of France came out and indicated they expect to see on their studies and everything else that first quarter French GDP will be down on a quarter-on-quarter basis 6%. So annualized US style, that's 24%. And they see that over the second 2 weeks of March, so after they introduced their big lockdown, they see economic activity, at least they regard economic activity as having plunged 32%. And they're expecting economy to contract by about 1.5% for every 2 weeks that the country is continuing to face a lockdown. So, I mean, these numbers are still, I think, I can't say back of an envelope. That's probably a little bit unfair, but it really does give an idea of just some of the magnitudes of that we could see in the upcoming data over coming months. And then, go back to your question, will investors see that and think, oh my Lord, should we really be buying equities at these levels?
But it's the length of that lockdown that we don't know. And the
Exactly.
longer it is, the longer this gap is going to be in production and stuff. So,
and there's also the issue of paying for all this stimulus that government's putting in place as well. And we've seen some talk about rating agencies looking very closely at just the long-term sustainability of it.
Mm.
It is. I suppose it comes also back to, and at the end of the day, though, we've got all this money floating around global financial markets. Where's it going to go? Now, I think we can see from some of the money supply numbers that, clearly there's a strong preference for cash at the moment, but ultimately investors have got to try and make some kind of return. So what do? I mean, do you start thinking, well, look, if the coronavirus numbers are getting slightly better, you pile in the equity markets and we end up just continuing on the kind of upward spiral that investors have come so used to over the last several years now, to the extent that perhaps there's going to be an even bigger fall at some point in the future, or it's got to go somewhere else. Somehow or other, at some point, these central banks are going to start having to, claw back all this money they put into, to keep credit markets flowing, to keep liquidity flowing through the system, or the thing's simply going to fall apart. So, difficult times. Anything else from your side of the world, Mark, that is worth pointing out? Have you got any good news? Give us some good news.
Good news.
Give us some good news.
Well, I think that the good news is that the break it lower is going to make the comparisons easier. I mean, I hate to look at that's the silver lining in a way, and that's I think what we're seeing with China, and I do see, like you said, Spain and Italy. There's clearly, a lower rate of infection, and the sooner that leads to the withdrawal of the shutdowns, the sooner the economic data will just start flying high.
Let's hope so. I must say, since the three of us talking on this, I'd be interested to know what people's views are on the kind of recovery. I mean, I'll stick mine for what it's worth in first. I think these financial markets appear to be taking the view that it's going to be essentially a V-shaped recovery. So, we get the bad news. Once it's out of the way, then we kind of get back to normal relatively quickly. My big worry would be that given the damage which is going to be done to the structural economies all around the world over the course of the next few months. So, the loss of what would have been investment, the loss of jobs, the number of companies, perfectly respectable companies, self-financing companies, which will go under as a result of the coronavirus, so essentially no fault of their own. It could actually take quite a long while to get back to where we would have been without the coronavirus in the first place. But I wonder, let's say, Brian, from your part of the world, what's the kind of, your sense, or indeed the general sense out there about what sort of shape the recovery will take when we finally get there?
Again, it varies across countries and across perspectives. I think that there is some hope that the numbers out of China will bounce back pretty quickly if there is success in actually getting things back to work over there. If they've managed to contain the spread of the disease. if they manage to avoid a second wave going through, then perhaps people will get back to work pretty quickly. Factories will ramp up production to sort of make up for lost ground, and you will see a pretty sharp response there. And if that happens, then you will see flow-on effects to other sort of cogs in the supply chain around the region, and that will be a big help. But it just really depends on whether we avoid sort of a second wave or other issues about that. Here in Australia, there is a bit of confidence that the fiscal stimulus and the economic support has been really targeted about trying to keep strong businesses in a holding pattern and avoid that risk of widespread bankruptcies and shutdowns. Just trying to hold on until we get through to the other side. So again, if that happens, you can have a bit of confidence that we can bounce back. But again, whether it's V or U or a Nike swoosh, I'm not 100% sure at the moment because we just don't have the clarity on the outlook for the disease, so you sort of need that clarity before you can then proceed to the economics of it.
No, fair enough. Well, at your side, Mark, is there a kind of consensus what sort of shape this recovery is going to take?
No, there is no consensus, but it's interesting that you should. We just had the FOMC minutes this afternoon, and the Fed in their minutes several weeks back in one of their emergency meetings last month basically listed two different scenarios. The first, a decline in GDP and rise in unemployment rate, followed by a rebound in the second half of this year. Or the second one, a full-fledged recession this year with recovery delayed until next year. So that's...
Did they attach any probabilities to these? Or
no, I think the first one, no, this is, their minutes are done in a kind of, for them, a conversational style. But the number one has significance. So that apparently, and they try to be upbeat. So, and they did everything they possibly could at the meeting. They cut, the Fed funds target by 100 basis points. They added $700 billion of new QE. And they've since done, you're talking about bankruptcies, a whole array of different kind of loan backstopping across markets. So they're doing everything they can. The central bank, the government's another issue. They're not as fast. They're showing themselves for economic policy to be less flexible, to be less certain. But anyway, the Fed having them on your side can't hurt. And so I would say, I guess I'm on the V camp, at least for the numbers, because the base is going to be so low. But how soon you can re-gear your employment force, your labor force, get it back into swing, get everyone, back in their place, that has never been tried before. And so we'll see how that turns out. Lots of unknowns. This whole thing is a huge unknown from the very beginning.
It is unknown, probably being the operative word. Okay, so I'll just round off from my side. The latest news on Boris Johnson, the UK Prime Minister, who is still in the intensive care unit as we record this podcast, but ostensibly is responding to treatment now. So we'll have to see how that goes. I suppose just to up people in terms of what that means for how UK policy works, as things currently stand while the Prime Minister is still in intensive care. The Foreign Secretary, Dominic Raab, he's the first Secretary of State, and so he's appointed as Boris Johnson's number two. So he'll effectively be running the government at the moment, without wishing to be miserable about these things. But if it were the worst case and Boris Johnson were unable to be returned to his role, then it would open kind of a can of worms in terms of what would happen to UK government policy, in the sense that we don't have a written constitution, and it would mean that although Dominic Raab is ostensibly Johnson's number two, he wouldn't necessarily be the chosen leader with regards to the overall Tory party, and we could end up with a new leadership challenge. So that's just something to keep an eye on. But touch wood, Boris Johnson does appear to be over the worst now, so hopefully things will work out okay there. All right, then. So let's call it a day for this week. On behalf of Mark, Brian and myself, thanks as always for listening. Do stay safe. Remember, the data also do still matter. So keep up to date with all the major numbers and events in Econoday's global economic calendar. And we'll be back next week. We'll see you then. Bye for now.